So it's unreasonable to assume that the recent decline, both in terms of duration and amount, is sufficient to cure all the ills that have infected, a good term these days, the system. And so we're not out of the woods.
Are you tired of hearing all the back and forth online about a recession, or worse, a financial collapse? It seems as though no analyst can fully agree with one another these days, let alone the federal government. Today, we're bringing you a clip from an interview with Charlie Dreifus, who is handing out guidance for these uncharted waters with his 50 years of Wall Street experience. Charlie Dreifus has been making a name for himself in the financial world ever since opening his Royce Small Cap Special Equity Fund in 1998. The stellar performance of his funds has been based on principles such as make money by losing less. His risk-averse approach protects profits when markets are sliding and takes advantage of upticks when possible. Charlie wrote a letter to his client earlier this year. It is intended to share his perspective about the state of the economy and where it may be headed. I'll read the most relevant bits to you. During 2020 and 2021, Washington pumped about $10 trillion of fiscal and monetary stimulus into the U.S. economy, and the result was a relatively minor increase in GDP of $2.3 trillion. Household net worth, however, increased by $34 trillion versus an annual GDP of only $24 trillion. Individuals were given 2 years of income in the form of higher values for their homes and securities investments. All of this appears to be unwinding now, and we should expect to pay the price as the economy regresses to the mean. From his perspective, the federal government has created a bubble by pumping stimulus value into the economy. Now that the dust is settling, it is revealing the financial system to be in a precarious position. It seems as though the only way down is more of a steep fall. This unwinding may be rapid and chaotic for companies and individuals alike. To dive deeper into this, we'll let the expert do that talking. Let's roll this clip from Charlie Dreifus' interview with WealthTrack.
And you are saying basically that it's not if we have a recession, it's how long and how deep it's going to be, and if it could end up being a stagflationary environment. How long, how deep, and what about stagflation, which we haven't seen in 40 years?
The Federal Reserve has to be decisive. They have to remove slack in the economy. We still currently have 2 openings for every person seeking a job. That mismatch will continue to cause pressure on the wages and the whole compensation package. And that service inflation can perpetuate a lot of other inflation. If the Federal Reserve is sincere about getting us back down to the historic 2.5% inflation target, there's a lot of pain ahead.
Right.
You don't cure a situation that we're in when you have 3.6 or 3.7% unemployment. Unemployment has to be much higher. Now, do we have the will and the fortitude to, take that on and endure the pain? But you cannot cure inflation. No country has ever been able to successfully cure inflation without the related pain.
One barometer that you look at in measuring the outlook for the stock market is the number of S&P 500 companies that are yielding more or less than the 10-year Treasury note. And for years and years, you had most of the S&P 500 companies, their yields were over the 10-year Treasury note, which meant that stocks were very attractive. I mean, they were talking about TINA. There is no alternative to stocks, and now that has reversed. So what does that tell you? And actually, you declared in the letter to clients that you wrote recently that TINA is dead.
Yes.
What does this mean for stocks?
It's another sign that tells you the risk reward has changed, because you can get, if you're seeking income, And I think, incidentally, income is going to be more important. I believe that we're headed in an environment where total return from the stock market will be considerably lower than it's been over this past decade. We have, and again, the 50 years has shown me this, there's always a regression to the mean. You over-earn and then you under-earn, and it eventually comes back to the trend line. So we've over-earned, so we're going to be earning less and dividends are going to be more important. But the point is that, frankly, the yield curve currently is inverted. You can earn more investing in a 2-year treasury, I don't know, 3.1, 3.2, versus the 10-year, which is 2.8.
Right.
So there are very few stocks that yield more than 3.2, and buying, there's a point that clearly you want to take advantage, you want to be opportunistic about the stock market. But I would argue, and frankly what I'm doing in terms of the accounts I manage, including the fund, is I dollar cost average. You don't plow in immediately. I learned a lesson in the aftermath of 1973-74, which was very comparable to today. We had
You think?
You
think?
Yeah.
Wow,
Yeah,
because that's a big statement. That was a terrible time for investors.
Well, but
devastating.
it followed the Nifty 50, which
True.
is the FANG. We embarked on very high inflation, and we had scarcity of oil that time only. But the similarities are quite compelling to me. And I had a trader that taught me a lesson, a very valuable lesson, because I was a young portfolio manager with a great deal of cash, fortunately, that in my account. I managed pension funds, which is a scary concept that a 30-year-old would be managing a pension account. But in any event, I was, and I had the wherewithal to buy a lot of stocks. And he said to me, "Charlie, you don't get it, it's a bear market." And this was late 74, and the market didn't bottom until 82. So he was very right. So he gave me the notion of thinking of a pyramid, start at the tip, at the top of the pyramid, and as the market declines, expand your buying. So you increase purchases at lower prices. And on days it goes up, don't buy anything, because it is more than likely in a day or two the market will be down. And that has, importantly to me, served my clients really well.
The investing wisdom that has survived decades of economic roller coasters is more valuable than any golden stock on the market. By using this advice, you can emerge from a major downturn in the market with the expectations of eventual profit. Let's quickly recap Charlie's strategy. In a nutshell, Dreifus has been managing his accounts with the mindset of buying good stocks when they are going for cheap. Particularly in a situation like our current day, taking advantage of the downturns is a key to floating on top when the tide begins to rise again. Imagine that you let the fear cloud your judgment and choose to hold all your money in your savings account while the market is sliding. It continues to drop for months or even multiple years. Your favorite stock drops from $20 all the way down to $5. As much as you would like to own it, you want to see green before you cash in. When the stock you have an eye on begins to rise, you are still afraid of it dropping further. After all, there have been plenty of false starts since the beginning of the recession. Eventually, it recoups the lost ground and you manage to snag it at $15. That's cool and all, but what if you had handled it like Charlie? Charlie would have bought that stock at $15, $12, $10, and snatched up everything he could at $5. By the time you bought in at $15, he had made profit hand over fist, all because he knew it was destined to rise again eventually. Losing less in a recession is about picking up the valuable stocks when they are undervalued, even if the entire market is undervalued as well. Investing during a downturn is not for the faint of heart, but we have a hunch that if you're spending your time seeking education online, you'll invest intelligently. Thanks for tuning in today, guys, and we hope to see you back again. If you've enjoyed our videos, leave a like and subscribe so we can continue to produce quality content for you here at Profit Protection.